So let's discuss today the other most important volatility strategy called as a long call butterfly and the short call butterfly strategy. So now why is this butterfly? Butterfly, the name is been given based on the payoff diagram. When you design a long call strategy or you design a short call butterfly spread strategy, the payoff looks like the wings of a butterfly. So that's the reason it has been given the name of the strategy as a long call butterfly strategy. The full name should be like long call butterfly spread strategy, because this long call butterfly strategy has been designed by clubbing two spread options. It is also called as a sandwich strategy, because you're trying to sandwich two spreads strategy and make this long call butterfly spread strategy, right? So when is that you can design this long call butterfly spread strategy? First thing, so you can design this long call butterfly spread strategy when you expect that the market is going to have very little volatility. Now when you say little volatility, we also seen in the case of like short straddle, where a short straddle strategy has been designed, or a short strangle strategy has been designed when you expect little volatility. What it makes the difference between the short straddle or this long call butterfly spread strategy is the risk and return. If you just look at there, the risk was unlimited and the returns were limited in the short straddle, but whereas in the case of like long call butterfly spread strategy, right, so you are having limited risk and limited return. The both the return and the risk are limited. Either you take long call or you take short call, the risk and the return are limited. So these are very important as well as very popular strategies people or investor would like to design. Now when it comes to designing, how we can proceed it, right? So we had to take positions into different strike prices in the same market with the different strike prices with the same what you say underlying asset, but the different strike prices. So the design goes like this. So we had to buy one call, right, which is in the money, right, buy one call which is out of the money. When I say buy one call which is in the money, whose strike price is less than the current market price. Buy one call with a higher strike price whose strike price is higher than the current market price, right? So then sell two uh, options which strike price is at middle. When you say which is near to the current market price, so that is buy one strike price which is less than the current market price, buy one strike price which is higher than the current market price, sell, take, that is nothing but take short position on a call where the strike price is near to the current market prices. In other words, it would be little confusion to you. To in simple, when we select the strike prices, compare the strike price and see that one strike price which is lower strike price, comparing the three different strike prices, right? So the lower strike price you need to take one long position, the higher strike price you need to take one long position on a call, right, and the middle strike price you need to take two short position on a call. This is what we call as a long call butterfly spread strategy. We are taking one long position on a call for a lower strike price. We are taking one long position on a call with a higher strike price. Strike price are different. Then we are taking two short positions, right? Not only one, we are taking two short positions on a strike price which is middle or which is near to the current market price. This is called as a long call butterfly spread strategy. Okay, similarly short call butterfly spread strategy, where short call, when you say sell one call which is in the money, sell one call which is out of the money, buy two calls which is at the money, or sell one call with a lower strike price, sell one call with a higher strike price, right, buy two calls which is middle strike price or a current market price, which is like opposite to that of a long call. To remember, when you say short call, one short call lower strike price, one short call higher strike price. This thing that you need to just as a memory. Long call, one long call, buy one call in the money, buy one call out of the money. Okay. So risk and return is also limited. This is what we call as a short call. In short call, when is that you will enter? When you expect that markets are very highly volatile in nature, right? When you say highly volatile in nature, this is quite similar to that of a long straddle strategy, right? In there also what we have is limited risk but unlimited return. But here it would be little better position. Risk would be much better and the return would be much better than the short straddle strategy. When you say better, the lower the cost, higher would be the little profits. Okay, this is about like short straddle strategy. Okay, we'll end here.